Welcome, everyone. Good afternoon or morning, depending on where you reside in the country. On behalf of the company, we'd like to thank everyone for taking time out of your day to join us for this brief market strategy update. My name is Keith Durand. I'm the Senior Vice President of Business Development for Lear Investment Management. I'm going to keep my comments brief. Looks like most of you have been on this call before, but those that might be new, Lear Investment Management, Rick Lear started the firm in 2009. Our legacy is in the private client side. We've been on the institutional side since actually February of 2015. We're a global, tactical, macroeconomic theme-based strategy with a unique risk management overlay that allows us to provide equity-like returns with less than equity risk. I'm joined today by Jim Warner, who's the head of research and co-PM. And before we begin, I would encourage everyone to ask questions throughout the webinar. There is a Q&A button at the bottom of the screen that you can just type in the questions, and we'll go ahead and answer those at the end. So without delay, I will turn it over to Jim Warner.
Great. Thanks, everyone, for joining us today. Let me share my screen, as I normally do. It should be coming up here. All right, perfect. So I think one of the things that we're going to do differently in this particular presentation is we're going to offer you a view that we've been working on now for some time that is probably unlike what you're going to hear from other macro commentators. And what we've basically figured out is that we think that deflation is on the way. So we were among the first people to call out that inflation was not transitory. I think we were one of the first folks to also declare that inflation was under wraps and trending down. And then I think we're going to be one of the first commentators to tell you that deflation is actually heading our direction next year. And we're going to go into that in some depth. So quick take first on where we are in terms of the market. And we experienced a material pullback in August. And if any of you read my newsletter from a couple of months ago, I went through an analysis about how what I call material pullbacks, or anytime the market pulls back 5% from its peak. And we got one of those in August. In fact, it's the first time we'd had one since the banking turmoil caused one in March. And this is normal in any bull market. And this provided a great opportunity to add additional equity exposure, which we did. Long-term interest rates have also been a big story during the last month. The market is really adjusting to the Fed's commentary that they're going to hold rates higher for longer. And so you've sort of seen the longer end of the curve move up to new highs. And there's been a little bit of volatility there. So we think it'll probably settle in roughly where we are today. This does raise a near-term question about how businesses and consumers are going to digest these higher rates. Now, we all know that various parts of the economy have already felt the impact of very high rates, such as the housing market and the used car market, for example. We'll go into both in detail here in a minute. But there are other parts of the economy where this is still kind of filtering through the system. And so we're very interested in how this filters through and how consumers are impacted in particular. Driving these moves in the market, this kind of pullback and this move up in rates, is actually very strong economic data. And we'll touch on that. But it certainly suggests that there's no broader recession in sight. This goes to the commentary that we made, I think supports the commentary we made a month ago, where we would expect the performance in the S&P to kind of broaden. As you all know, the top 10 tech stocks have really been leading the way and leading the charge this year in terms of performance, leaving a lot of the more typical cyclical stocks left with very little performance this year. We think that may change. We think there may be some catch up with those cyclicals in light of the strong economic data. But there is greater evidence to suggest that deflation is around the corner, and we'll walk you through why we think that. So last month was basically a typical buy the dip moment in a bull market. That's certainly something we saw. One of the indications that it's a good time to buy the dip is how low the VIX has been. So the VIX, measure of volatility being well under the kind of 20 threshold that we look at for risk on. That is definitely an encouraging sign to buy that dip. The biggest issue for portfolios, and I'm sure you've all experienced this, is fixed income this year has just been a big drag on returns. With the equity indices up fairly nicely, the aggregate bond index is just up 1% year to date. And a lot of this has to do with the fact that interest rates towards the longer end of the curve, in this case, I'm showing you the 10-year Treasury yield, is basically generally up for the year. And that's been the big drag. Now, a lot about what I'm going to tell you is going to indicate that we think that portfolio drag may be nearing its end, and that 2024 in particular could be fixed income's time to shine. But what's driving all of this, current movement in the market is that the economy appears to be firing on all cylinders. Now, we've shown this graph before, and one of the things we've pointed out is that if you take the conference board's forecasts, and you could insert any broker-dealer you want in this, but essentially they've been too conservative. They were too negative. And they've consistently been forecasting a recession, which has yet to come. And meanwhile, we have a counterpoint with the Atlanta Fed's GDP Now real-time forecast, which synthesizes all of the economic data points as they come in. They now believe that for the third quarter of this year, that GDP will grow as much as 5.6%. Now, I'll caveat that by saying they're generally never right, and it's probably going to come in lower than that at the end of the day, but it's still indicative of a very, very strong economy, certainly one that's stronger than expectations. And what's really going on here is that consumption has really been driving the additional strength. And what I'd also add is that we might see this strength continue certainly into the fourth quarter as inventory builds start to help propel GDP along. So we think that this is, on a very near-term basis, i.e. through the end of the year, a positive signal for stocks, and in particular, the cyclical stocks that are playing catch-up. I've updated this slide, which I've used in previous presentations, just to show you just how Goldilocks this economy is. I used our favorite real-time inflation metric from Trueflation, which indicates that inflation is definitely under control and headed towards target. More on that in a minute. The labor market in the top right, you can see, continues to be very strong, although the job ads are actually starting to decline, but it's still a very strong positive labor market, which is fueling higher and higher personal consumption expenditures or spending. And that in turn is allowing the services PMI to continue to remain at elevated levels. In fact, just before we launched this presentation, another ISM services PMI number came out, and it too reflected a strong low 50s number. So everything seems to be going very well in the economy. Well, let's talk about deflation, because nobody else is. The Fed's key metric for inflation that they focus on, and I'd encourage you to read Chairman Powell's remarks from Jackson Hole just a week or two ago, but he really goes into what the Fed is really looking for. And what they come back to is core PCE. Now, this is a measure of inflation that excludes food and energy prices. So think goods and services in the economy. And what the core PCE, as you can see, it never got as bad as CPI, but it's also not coming down as fast as CPI. And so what's really going on here? And what we would suggest is that there's a collapse coming. So to disaggregate PCE between goods and services, let's first, as I do here on the left, the graph here on the left, the blue bars is the PCE inflation for goods. And you can see it was very elevated. This is at a time when, during the pandemic, of course, people were flush with fiscal stimulus cash. There wasn't enough supply. There was a huge follow through in terms of inflation. The green bar is the services inflation. And you can see it's remained fairly steady in this 4 to 5% range over the course of the last couple of years. Now, what's really going on, in the goods, as we now know, is the combination of zero interest rates and all of the extra stimulus dollars and the limited mobility that came along with COVID restrictions. We saw big booms in inflation for things like used cars. And used cars also, if you remember, benefited from the fact that there were supply chain problems that were impacting the production of new cars. Well, as you can see that the used car price skyrocketed as much as 45% during the peak problems and peak demand in late 2021. And for the last number of months, really all year, we've seen actual deflation in the number. And so that's broadly happening as you're seeing essentially a broad level of deflation in goods. But what we really want to focus on today is, and that, by the way, the latest reading was, I think, negative 0.8%. So for the last 2 months, let's just go back to this. You can see the last 2 months for goods have actually been negative. So these small negative numbers for goods deflation are in the overarching headline 4.2% number. But what I want to turn to is what's going on with services. So the biggest issue that we see that the economy is going to face in the next year is housing prices. And we think that they are set to fall probably by a lot. Housing comprises 17.5% of that headline PCE number. And if you disaggregate the goods, which is about 2/3 of that headline PCE number, or 1/3, with services, which is about 2/3 of that headline PCE number, housing is about a quarter of that services piece. So it's a meaningful part of PCE. Within the current headline PCE number of 4.2%, housing grew 6.8% in July. Now that seems doesn't really sound right, in terms of what we know about mortgage rates, which have now hit the highest level that we've seen since the year 2000. So the current rate around just north of 7%, we haven't seen that in a long, long time. And so the combination of houses just being that much more expensive to purchase, it sort of intuitively makes us think that these housing prices are going to have some serious headwinds. And you can even see that growth in inflation has started to decline, according to that metric. Well, we dig in a little bit further. What we find is that housing is the least affordable, actually, since 1986. And this chart represents essentially whether or not a family earning a median income is able to afford the mortgage payments on a median existing single-family home. And when it gets below 100, like it is today, the answer is they can't. The average family cannot afford the average home today. And we haven't seen that since ever, really, since at least the index began in 1986. And you can even see that going back into, we look back to the housing crisis, houses are even more unaffordable than they were then, just to put this into perspective. So so I think what we can conclude is that with mortgage rates as high as they are, which is clearly forcing this issue, and prices have risen so much over the course of the last few years, that something's got to give. So let's just use some simple math to sort of lay out what the problem is that we see going forward. If we look at this house on the right, which is currently a $1 million house in Dallas, a 30-year mortgage, assuming 20% down on that $1 million house back in December of 2021, would have gotten a mortgage rate with an interest rate of 3%. And that would imply a monthly payment of $3,374. That same house, let's just say it didn't go up in value, but because it did, but that same house, let's just say it was $1 million or a different house worth $1 million, now has a mortgage rate of 7% if you were to buy it today. And that's a monthly payment of $5,322, which is a 58% increase in the monthly payment. That's the ugly mortgage math today. So something's got to give. So the question that we're asking ourselves is, well, how low will home values go? The Zillow Home Value Index is one of those indices that uses more real-time data. And for anyone who, has listened to previous webinars, that what we like to do is we'll take the government driven data and then we'll look for something that perhaps industry has that's more present in real time. Well, the Zillow Home Value Index, which looks across all the homes in the United States that they have, that they valued, which I believe is, a considerable portion of them, they registered only a 1% growth in housing prices in July, which is well below the 6.8% I referenced earlier that's embedded in the PCE core inflation number, right? If you actually look at this index further and in more detail, you'll see that home values are up 45% since December 2019, which is really phenomenal. So not only do we have record high mortgage rates now, basically going from 2 to 2.5, 3 to 7+. We also have home prices that have basically gone up almost 50% since the beginning of the pandemic. So that's an enormous surge. And you can just see it in the line graph below, this big surge in the home value index. Now, the positive thing about this is that many people have built significant equity in their homes and can absorb material price deflation. So if we get this big fall off in housing prices, like I expect, it's not going to be like the situation in 2007 where nobody had any equity in their homes. And that's why you had big default rates, which I'll get to in a second. Most importantly here is that you have a lot of equity stored up. And so that's why I'll say that while we are going to get this housing price deflation, and it could be quite significant, this is not 2007, 2008. This isn't going to lead to a mortgage crisis, and for a number of reasons. For one, the underwriting standards have been much more conservative since the housing crisis during the great financial crisis. And you can see it in the loan to values. On the chart on the left, the green line is the average mark to market loan to value. So these aren't just this is real time data, if you will. But through the first quarter, essentially loan to values had decreased to 56%. So just think about the inverse. That means that there's 44% equity. Okay, so that's a lot, and that's a nice big cushion. The other thing I'd point to is that the average homeowner right now, if you look at all outstanding mortgages, is paying a 3.7% rate. So that's obviously a lot lower than 7%. So if you don't have to sell your home, don't sell your home, because you're not going to get anything more attractive in terms of rate, and you're not going to be able to get as much house for your money, given what I showed you on price. The other piece that I think provides some measure of stability to the housing market is that there's very few adjustable rate mortgages, which means there's very low interest rate reset risk. So if you look at the chart on the right, there only 4.8% of outstanding mortgages have adjustable rates. And remember, one of the big problems that triggered the 2007-8 crisis was that you had higher interest rates, and we'd come from a period of almost zero interest rates or very low interest rates in the earlier part of that decade. And then we had these 5-year ARMs reset. And so folks all of a sudden were faced with much higher mortgage payments than they were prepared to pay for. We don't have that risk as by any real standard this time around. So what I did was I basically said, what if we take the core PCE number? Okay, the core PCE number today is 4.2%, as we mentioned earlier, and embedded in that is a 6.8% number for housing. And what if we held all else equal? Okay, so all of the services that don't include housing, and we keep that the same where it is today, which is in that 4 to 5% inflation range, and we also leave the goods inflation in the PCE, which is currently negative 0.8%. Leave those the same and simply change the housing input to this number. What would the core PCE headline come out to be? And if we use the Zillow data, which I just showed you, which said that home values were only up 1% in July, the core PCE number drops to 2.3% from 4.2%. Now that, by the way, is a lot closer to the Fed's target, which would suggest to me they're done. And we're going to see probably a pause, and we might not see another rate hike And I think a lot of the feedback we've heard in the market recently supports that as well from Fed speakers. What if housing prices go down 5% or 10% or 15% or 20%? You can see in the column to the right what the headline core PCE number does. And when you get housing prices down around 12%, which considering they're up 45% since December of 19, and we have the highest mortgage rates around, doesn't seem too unreasonable. But if they're down as much as 12%, the headline core PCE number flips to negative, and that is deflation. And that could spell a very different type of market environment, which is why we're sort of rolling this out now so that we can prepare for what seems to be an inevitable deflationary scenario. So what does this mean? Well, as I just mentioned, I think that the Fed is done hiking, and what's more is they will probably have to cut rates fairly aggressively next year if housing prices really start to roll over. Again, there's going to be this lag in the actual core PCE number. Remember, it's still at 6.8% for housing, but roll the tape forward 6 to 12 months, and you're going to start to see that deflation hit that core number. So, and the other thing I'd point out is that economists are more afraid of deflation than inflation. Why? Because just think about what's happened to Japan over the course of the last 30 years. They had this giant inflationary boom where all prices went way high, and then they went through decades of lower and lower prices. Well, when you get lower and lower prices over some period of time, what do you do as a consumer? If I need to go buy, a new dishwasher, but I don't really need it right now, what am I going to do? I'm going to wait. And in order for the economy to kind of move and grow at a consistent pace, we can't have everybody waiting to buy things, right? We need to have essentially people motivated to buy things, not when they absolutely need something, but when they want something. That's generally how the economy works. And so we think that the Fed will step in and likely be much more aggressive than what the current curve implies, which is 140 basis points of rate cuts through the end of next year. We think they have, if this plays out the way we think, they're going to have to be much more aggressive than that. Now, that could create some market volatility. That could stoke recession fears. We think it's entirely likely that the media will, pull out the 2008 handbook, playbook, and start to draw linkages between where we are today and the 2008 housing crisis, which, as I just indicated on the prior slide, that we think is going to be a bad linkage and unsupported, but it could happen. But ultimately, so long as mortgage defaults don't pick up, the economy should be able to manage through it. So it gets back to, do people have jobs, right? And right now we're dealing with a very, very strong labor market. So it seems to be that we will manage through it, but we're going to have to deal with this ugly math next year that suggests deflation. Now, as of course we move through that year and those rates get cut, so too mortgage rates will decline, and that will actually help cushion any blow to the housing prices. But remember, the average person out there has a mortgage of just 3.7%. So that's a long ways away from 7.2% today. So I don't know how low we need to go in order to start motivating buyers, but it's going to be some blend of rate and price. Maybe it's 5% that rates get to and prices come down 15%. Maybe that's where we find the equilibrium, but we're not really sure. But what we do know is that we need to start preparing for this type of scenario. So what's the standard deflation playbook? I think that's something that people are going to talk a lot about. And by the way, we're not sure that this is going to apply. In fact, our base case is that it won't be as bad as what the standard deflation scenario would amount to. But it's worth understanding what typically is the playbook. So typically in deflationary scenarios, it's usually accompanied by a recession driven by lower aggregate demand. Like I said, people put off their purchases. So that lower aggregate demand causes an inflation. It also, the lower prices means that you get lower earnings. So generally you want to prefer bonds over stocks. And in this type of environment, the name of the game is protecting capital, not growing capital. And so you prefer stores of value, cash, treasuries, precious metals like gold, which we own throughout portfolios. We own treasuries, we own cash, and high quality fixed income like the mortgage-backed securities that we've been super fond of over the course of the last few months. Those are going to be great stores of value. You also want companies with predictable earnings. These are your dividend aristocrats. They have dividend yields. They've grown consistently throughout the decades. These might be defensive names like healthcare and consumer staples, where you're not going to see the same sort of price elasticity issues that you might see in other industries. In addition, you want to find names that have competitive moats, and technology is a great place to look for that. So with a combination of lower interest rates and competitive moats and the overall kind of powerful secular themes like artificial intelligence and things like that, we think technology would be a really good place to hide out in. What you'd want to avoid is banks, right? Credit risk, super high yield bonds, real estate, commodities that are more industrial and cyclically based. So again, the name, if we actually had sort of broad deflation across the economy, this is the playbook that you'd want to adopt. And it's to protect capital, not to necessarily grow capital. But what do we think is the most likely outcome? So we think that this deflation issue that we're talking about is a next year problem. Near term, like say through the end of the year, or maybe over the next 6 months, we actually think that stocks will benefit from a strong economy and the declining inflation narrative, right? And so when deflation does start to kick in, and that starts to dominate the conversation, who knows? That could be next March. It could be next summer. It's always very difficult to time these things. You will see the Fed then start to kick in lower rates. And who knows, maybe the Fed will be slow to do it. And this in turn will trigger lower mortgage rates. You'll also see that on the positive side, the lower goods prices, so long as it's coupled with continued wage growth. And by the way, when you start to get deflation and wages on a nominal basis are still actually rising, your real wages go up a lot. And that actually can be very supportive to consumption, which is a good thing. So there's sort of good deflation and bad deflation. And the market's going to take some time, I think, to try to figure out which is which. We don't, for example, though, expect a spillover of deflation into services, sort of the non-housing services. But I think this is the key thing that we'd have to watch, because that would, if you did see that spillover, that would cause you to want to deploy the deflation playbook we just talked about. So at present, the key thought in our minds is that many companies raised prices over the last year or two to combat input inflation, right? Whether that was wages or the actual costs of things that they produce. But with inflation gone, and will prices normalize? In other words, there are going to be places where a supplier, if you are supplying another company, let's say Walmart, let's say it's, I don't know, a widget, and now it costs less to make that widget, Walmart's probably going to want a discount from you. So there's going to be some price elasticity across various different sectors and different goods. And I think picking your spots as to where you're playing is going to both protect capital, but also give you the opportunity to find those places that are not impacted by those issues. And that's kind of where you want to be. But overall, we think this is going to ultimately be a great environment for fixed income, which again is good because it's been such a drag all year long. And we think it's going to be generally good for stocks. It's just going to really matter where you're positioned. So to speak directly to the portfolio, and you've seen this slide, and this slide gets updated every month for how the global Vigilance portfolio, which is a moderate risk portfolio in which many of our clients are in, how it's laid out with all the different themes. One of the things that we got, as I mentioned, is that material pullback last month. And so we did deploy cash, excess cash on that dip, because we had raised some going into it. We'd trimmed some technology, for example. And so we added back to those technology names. We also have a growing confidence in our mortgage retrade. Mortgage spreads have blown out way too far. There's too many people looking at it. We think that there's a great opportunity. And if any of this deflation thesis actually works, because these are agency mortgages, they're guaranteed by the government. We think that trade could be incredible. Knock on wood. We also have higher hopes, as I mentioned, for other fixed income. And certainly what we're doing now is we are, essentially trying to begin to insulate the portfolio from this deflationary scenario. Now, we know we're probably early. That's our biggest problem in investing is that we see things before other people do. But I think this is one of these situations where getting ahead of it is really important. So we are gradually moving portfolios and models to protect against that scenario. In the meantime, though, our watch list keeps growing. With a strong economy, with the pullback that we recently got, obviously technology, AI, cyber, networking, there's just tons of opportunity that we see. We see enormous opportunity in electric grid infrastructure. As we mentioned a couple presentations ago, many thousands of electricity line miles needs to be built if we're going to get anywhere close to the forecast for electric vehicles and other types of electrification of products. And then there's a lot of misunderstood stocks. So anytime you have this kind of interesting situation where there's been question marks over the economy, I think there's fewer questions now. There's stocks that basically have been kind of left behind. And so some of these are very misunderstood, and we're finding a lot of attractive opportunities there. So let me stop there. And of course, in the appendix, we'll share this presentation with you all. We always put in some market statistics. But let me stop there, Keith, and let's do some Q&A. I'd love to hear your thoughts.
Yeah. So before we kind of move to the questions, what about our current allocation? We're I think roughly 50% in equities. Yes. And talk a little bit about what we see through the end of the year in terms of either more equities or less equities, particularly given 2024 in a possible deflationary environment.
Yeah. So good question. So essentially where we sit today is roughly around 50%. That's in our moderate version. And for those who aren't aware, we also have conservative models, we have more aggressive models, but this is kind of our flagship. So we tend to refer to everything within the context of that. So within that allocation, we also have 15% in these mortgage REITs. And these mortgage REITs are very special animals because while they are invested in agency mortgage-backed securities, which are very, very attractive, they also have leverage attached to them. And so they're able to produce 15% dividend yields. So while we'll kind of classify them as non-equities, they are still going to behave, more in certain markets, they'll behave more equity-like, in certain markets, they'll behave more fixed income-like. Where we sit today is, and obviously we have, quite a bit of fixed income as well, which, again, has done better than the overall bond market. But essentially that's been the drag overall on returns. I think where we're sitting is not huge amounts of change between now and year end. We have, over the course of the last 6 months, ramped back up our technology exposure. I could certainly see us adding additional technology exposure. I could certainly see us adding more exposure to the electric grid stuff that I just talked about. And then there's just other things that sort of come by the by. And sometimes, the way this works is it's just we substitute one equity that we like more for one that's already in the portfolio. But by and large, this is not a big, huge risk on into the mark, into the year end. And remember, we've got plenty of exposure to kind of the top 7 names that have done so well, but it's actually all the other ones that the market has kind of left behind that we really expect to contribute to returns in the next few months. Now, we're doing all this, as you said, Keith, within the context of, okay, at some point, the market's going to wake up and realize that we're going to have deflation. And what's that going to look like? And how are we going to position things? And I would tell you that, like, as we sit here today, we're pretty well insulated. Now, there will be some volatility if things play out the way we think, and there will definitely be some adjustments, but and one of them could be to reduce the equity exposure. But I think for now, we're sort of in a position where we like to add equity exposure on pullbacks, but as we get closer to that day when the narrative flips to deflation, we will have to make adjustments to protect capital.
Okay, awesome. So yeah, we invite you to use the Q&A button at the bottom to ask questions. It looks like we have one. What about the deficit and its impact on the market? And is Congress going to increase the debt limit in September?
Well, I only have an opinion on the second. On the first, the deficit is clearly eating more. The servicing the debt is clearly taking more and more dollars, and it is not at a point where it is a problem, but I'm definitely in the camp of someday it will be. And what does that mean? Does that mean higher taxes? That means cutting expenses. Or, what happens is we get this deflationary environment and we cut interest rates, and all of a sudden the debt servicing becomes less of an issue. I think that's probably the most likely scenario, is that rates head lower next year and the debt servicing is reduced. Now, I will say that it's very interesting. One of the many data points that I look at on a daily basis is what's happening in the repo market. So basically, we're in this weird transition point where, remember, the debt limit crisis that we experienced back in May/June was, what it basically did was it caused fewer participants in the treasury auction because of, obviously, they couldn't issue, and so people piled into the repo market. And now what you're finding is in literally the last few months, the Treasury has issued over $1 trillion in treasuries, and there's been tons and tons of demand for it. And you've seen that, essentially then it come out of the Fed's reverse repo market and back into buying treasuries. So at this point, there's plenty of demand for the treasuries that need to be issued. Now that doesn't mean that it's going to be that way forever, right? At some point, Congress needs to get their act together. And, I think from the perspective of the debt limit, I think this is probably going to be an issue that gets kicked towards after the presidential elections. I don't think that, first of all, I don't think there's the votes by either party to actually make, to accomplish anything other than a compromise. But, and I'll say from a personal standpoint, the debt limit is a joke, and it just adds a layer of complexity that we don't need. These are bills that were passed by Congress, so you got to pay them, period. And why this becomes an issue periodically is really kind of silly, but it's a political football. I think they'll kick the can down the road like they always do.
Yeah. Given there's such a strong labor market, and the consumer has been really resilient, does that, assuming that people continue to spend money and that part of GDP remains, does that change any of the outlooks that you've laid forth during throughout this presentation?
Well, I mean, that's going back to an earlier point I made. The number one thing we're looking at is how does these much higher interest rates ultimately impact consumers and businesses? So, think about it this way. Rates are still rising this year pretty considerably, but think about next year. Think about the interest expense that businesses are going to have to pay on loans, or think about the extra interest expense consumers are going to have to pay on credit card bills, or anything else that's a variable rate. That's where you're going to see weakness. That's where you're going to see probably some impact on consumer spending. It's consumer spending has been remarkably high for probably too long. Now it's being helped this year that because there's less inflationary impact, and we have lower energy prices, and we have lower food prices, and we're getting some help on the goods side of things with some deflation there. So there's elements of where this deflation or disinflation is helping propel this spending. I'd also say that household balance sheets are much better than they typically are going into previous recessions. So to the extent that we go into a period of, in this period of high interest rates, there is more ability to absorb it. But this is exactly what we're looking at. I don't know the actual answer of what this means, but I can tell you that I'm watching credit card securitization trust really closely to see if debt charge-offs increase. Think about some of the other things that are happening, like student loan payments. While it's not a big deal to most everyone, it's a big deal to some people. And so does that impact certain retailers more than others? And so I think as you think about these big things that are happening and how they get filtered through, it's going to be sort of a layered impact. It's going to hit certain parts of the economy differently. In other words, we've talked about how rolling recessions have been occurring throughout the broader economy in these different sectors. We will continue to see rolling recessions throughout various different parts of the economy. And we'll see some of these sectors that are already in it. It may take them longer to get out of it. For example, like being a car dealer. It's going to be very difficult at very high interest rates over the next year. So it really does come down to then what happens on this deflationary thing. So if we're right, ironically, if we're right and there's deflation, there are certain sectors that are going to be massively helped by that, by the eventual cut and dramatic cut to interest rates. So this isn't a very simple answer, because it's not a very simple answer. It's going to have, there are multiple currents that are going, and some are bad and some are good. And so it's really going to come down to being in the right asset classes, with the right levels of credit risk, with the right and in the right industries, with the right themes. And how that plays out on a broader basis is going to be much more complicated to understand.
Awesome. Very good. Well, we're at about 45 minutes. I think we're out of questions. So with that, just let me say thank you, everyone, for joining us. And we look forward to seeing you again next month. Bye-bye.
Thank you.